Very good afternoon, everyone. Thanks a lot for tuning into today's session. I'm Anugrah, one of the founders at smallcase. As most of you must be aware, this is the fourth webinar in the series of 5 webinars that we have planned for you. Let's just quickly recap what we have covered in the first 3 webinars before we move on with the investing strategies. That's the topic for today's webinar. The first webinar was about understanding the concept of a small case, where we talked about portfolio and thematic investment approaches. And we also covered different types of asset classes available for retail investors and did a very small comparative analysis to establish that equities are the best asset class for long-term investing. The second webinar was about finding your small case, basically how one can use different types of filters and tools available on our platform to find a particular small case which might be suitable for him or herself. The third webinar, which was the last webinar that we did, was about buying, creating, and customizing a small cases. We saw all the different types of action that can be performed on the small case platform, that is buying a small case, rebalancing a small case, managing small cases, and ultimately trying to create a personal small case or customizing one of the pre-built small cases available on the platform. Now, today's webinar is about investing strategies, and let's now jump into the different types of investment strategies that are available on the small case platform. Now, before we go into the details about these investment strategies, let's just quickly try to understand what we are trying to establish here with a very small example. Now, before you take any investment decision, whether it's an investment into a house, whether it's an investment into an FD or any other asset class, the most important question that one should ask himself is that why I'm putting my money into one of these asset classes or one of these instruments. Now, let's try to see what could be the possible cases of um like different types of cases where one decides to put in the money. Now, let's take the example of buying a house. Suppose you have visited a locality and you have found out a very beautiful house and you want to buy the house. Now you start talking to your friends, different brokers which are active in that locality, and establish that the fair price of the house is around rupees 10 lakh. So the first case is that when you have established that the fair price is rupees 10 lakh and you have taken into consideration all the different aspects, but the owner is willing to sell the house to you at just 8 lakh rupees. So it's a straight discount of 20%. Now the obvious question is, why would anybody do it? Now, so there can be multiple reasons why the owner wants to sell you the house at such a 20% discount. Suppose the owner has been transferred to another city and he urgently needs the cash, so he might be willing to give you a discount to incentivize you for a quick purchase. So this is the case one when you have established the fair value of a particular asset and and you are getting a discount, and the reasons of the discounts can be multiple, but right now in this case we are saying that the owner is in urgent need of cash, and that is why he is giving you a 20% discount. Now let's look at the second case. The second case is that now the owner is not willing to sell you at 8 lakh rupees, but instead of it, he is asking for 11 lakh rupees. Now, the obvious question is, if you have established that the fair value of the house is 10 lakh rupees, why would you pay 11 lakh rupees? So, to make things more interesting, let's put in another factor into consideration that uh, you you discovered with a little bit of extra analysis that the price in that locality has been increasing at a very rapid pace. That is, there has been an increase of 20% year on year for last 5 years, and people are saying that the same sort of price increase will keep on continuing in future also. In such a scenario, you might actually be willing to pay 11 lakh rupees when the current fair value is around 10 lakh rupees in anticipation of a price increase in the future. Because if your analysis is correct and the same sort of growth rate continues in future, 5 years down the line, you might be able to sell the house at 20 lakh rupees. So in this case, you're not worried about whether you're getting a discount currently on the property or not, but you are taking into consideration the rapid growth that the asset might be experiencing, and then deciding to put your money into. So the first case, when you are getting a straight bargain of 20%, also is a very meaningful case where one should definitely go and invest in anticipation of a correction in the price. The second case, where the price is where the house is available at a little bit of premium, but you are still going and investing in anticipation of a capital appreciation. So the first case was about correction in the price. The second case is about the capital appreciation. Now let's look at the third case. Now, the same house is present in a locality where there are offices of a lot of multinational companies. Now, because of this, you're pretty sure that there'll be a lot of high net worth individuals who would be working in such offices and would try to find a house very nearby and would be willing to pay you a higher rent compared to any other locality. So, in this case, also, it might make a lot of sense to put your money into this house because it will offer you superior rental yields. So these are the three different cases, and these cases are perfect examples of different investing strategies that we would be discussing in today's webinar. The first case where you are getting a straight bargain or a discount of 20% is the example of value investing strategy, where you are trying to invest into an asset in anticipation of a price correction. The second example where the asset was right now available at a premium, but you decided to invest in anticipation of high growth and in future is an example of growth investing strategy where actually you're betting on the capital appreciation. And the third case, where you expected high rental yields, is an example of income investing strategies, where one basically invests to keep on receiving fixed amount of income every period. Now, let's go into a little bit of more detail about each of these investing strategies. First is the value investing strategy. So, in case of a stock, we can say that there is a value investment opportunity when a stock is available at a price lower than the intrinsic value. Now, the important point is to understand what do we mean by intrinsic value. So in our example, you established that the fair price of the house was rupees 10 lakh. So the intrinsic value of the house becomes 10 lakh rupees. Now, in case of companies, one might expect that the companies keep on growing also. So you need to take into consideration a lot of other factors when you're deciding the fair value of the stock of a company. But let's not get into all these details, and for the time being assume that you are actually able to establish the fair price of a stock by considering all the different types of factors that are impacting the price of the stock. Now, once you have established this fair price, if the current stock price is less than this fair price, that is the intrinsic value of the stock, we say that there is a value investment opportunity right now available in the stock. Now, there can be multiple reasons for this discount that is available on the stock. Now, there can be good reasons, there can be bad reasons also. So, the example that we discussed, when the owner was willing to sell you the house at a discount of 20% because he was transferred to another city, is an example of good reason. But suppose if the property was illegal and there were a lot of pending legal notices on the property, and the owner actually decided not to tell you all this information and wanted to get out of the property, and this is an example of a bad discount that is available on the property right now. And even when the property is available at a discount, one should not get into it. The similar sort of situations can occur with stock market investing also. A company's stock might be available at a discount, but there can be good reasons behind it or there can be bad reasons behind it. Now, bad reasons could be that there is a management shakeup, or there are some inquiries established against the management. In such a scenario, even if there's a discount, even if there's a huge discount available on the stock, one should not try to get into such companies. Now, the second case might be that there's some very short-term news that has hit the market, and because of which the market participants have overreacted and the stock tanked. And you think that in future this news is not going to have material impact on the price of the stock. In such a case, it could be a very good opportunity to get into the stock. Now, for example, it might happen that when the company is announcing quarterly results, there was a one-time investment that company put out, and because of which the earnings for that particular quarter was negative, let's say. But market participants didn't give too much attention to the details and the stock tanked. But on further analysis, you established that this was just a one-time case, and in future, again the quarterly returns will be back on track. So this discount might actually offer you a very good opportunity to get into the stock. So this is an example of value investing which one should try to follow while deciding their investments. Now, there are different ratios which value investors use in order to identify undervalued stocks. This could be PE ratios, PB ratios, enterprise ratios related with enterprise value. So there's a plethora of ratios which are available for you to use and analyze whether a particular stock is undervalued. In this webinar, we won't be going into the details of all these things because it will take at least 3 to 4 different webinars just to cover these types of value investment ratios. But we would try to establish what do we mean by different investing approaches and how you can execute them quickly on the small case platform. So in the chart that you see on your screen, basically it represents the 2-year performance of an equal weighted portfolio of value investing strategies that are currently available and live on our platform. You can check out the collection of value investing strategies on the discover page in our platform, and there are 4 different value investment approaches that are right now available. Now, this graph shows the performance of an equal weighted portfolio of these 4 strategies for last 2 years. So if you would have, let's say you decided to invest 1000 rupees 2 years back and 250 rupees going into each of these value investing strategies, your portfolio would have generated a return of close to 100%. Now, this is a far superior return compared to the Nifty, which has barely generated a return of probably somewhere in the range of 5% in last 2 years. So we can clearly see that currently in current scenario, value investing strategies are working in the Indian market. Now let's move to the let's just quickly look at few examples of value investing strategies that are currently available on the platform. The first one is the bargain buys. As the description shows, the small case tries to select quality stocks which are available at low valuations. Now, I have listed down some of the factors which we use while creating this particular small case. Now, the factors that we have listed is not the comprehensive list of all the factors that we consider when we are building a particular small case, but basically the important factors which were considered for this particular small case. Now, in this case, as you can see, the first factor is low price to average 3-year EPS, and the second is low PE and PB ratio. So basically, these two factors are trying to identify undervalued stock, that is the stocks with low PE, PB, and low 3-year average EPS ratios. Now, once these two factors selects the undervalued stocks, by using the next two factors, we actually try to remove the bad discounts that are available. I'm referring to the bad discount and good discounts that we just discussed, that the company might be undervalued because of some bad reasons, or it might be undervalued because sometimes market participants have a tendency to overreact. So by looking at factors like positive EPS, DPS, or the capability of the company to fund long-term debt with its working capital, we can actually try to avoid the bad discounts and segregate the good investment opportunities. Now, this is small case is one of the most popular small cases on our platform because the minimum investment amount for this small case is also very low. It's close to 1700, and it has generated like an awesome return of 90% in last 1 year. The second value investing strategy that we would be discussing is the cash cows at bargain. This is also live on our platform and has generated a return of more than 60% in last 1 year. This strategy focuses a lot on the free cash flow. So many of the famous value not just value, many of the investors, like famous investors, have told us again and again that the perfect gauge to measure the profitability of a company is the free cash flow available. It is not the revenues, it is not the earnings, because these are the things that can be manipulated by a lot of like accounting techniques and other things. But free cash flow is something which is very hard to manipulate, and this small case focuses especially on the free cash flow that is available with the company. So as you can see, the first factor that we are considering is the low enterprise value to free cash flow. This is the factor which basically establishes the discount that are available on the companies. And by using the other three factors, that is an increasing free cash flow, a high free cash flow to long-term debt ratio, and improving free cash flow to debt ratio, we are trying to segregate the bad discount versus good investment opportunities. Now, there are other value investing strategies also available on the platform, and you can check out the full collection on the Discover page. Now let's discuss about the growth investing strategy. Now, this is the example of the second case that we discussed in the example where we were trying to buy a particular house. That is, the house was actually available at a premium of 10%, but still you were willing to buy the house because you were expecting that the price of the house will keep on increasing in future also. So basically, the main difference between value investing and growth investing is that growth investors are not trying to find out discounts that are available in the market, and they are not hoping that if they buy into the bargain, the price will correct and come to the fair price and they would be able to make profit. But they are trying to find out companies in high growth sectors and companies where there is an anticipation that the growth will continue in future also, and they are not much worried about discounts. But suppose if there's a company which has very good growth potential and at the same time has been growing constantly for like past 2 to 3 years, if such a company is available on a discount, that's the best investment opportunity that you can get, because there is growth also and at the same time there's discount also. And some of the small cases that you'd be discussing for growth investing strategies basically try to do that. And now the chart that you're seeing right now on the screen is the 2-year performance of an equal weighted portfolio of growth investing strategies. Now, as you can see that this portfolio has also generated returns very close to the returns generated by the value investing strategy portfolio. That is, we are still very close to 95 to 100% range, as you can see at the end of the graph. And this has been generated in last 2 years. And this is much better compared to what a normal Nifty ETF or the broader market has offered. So it proves that the growth investing strategies are also working. Now let's quickly look at the examples of growth investing strategies that you can find out on the small case platform. The first one is the Naked Trader small case. The small case selects companies as per the criteria in the book Naked Trader by Robbie Burns. And some of the factors that are used in creating this small case are the first one that I've listed here is basically increasing EPS, TPS, and revenues. So right now, using this factor, this strategy is trying to establish or find out companies which are experiencing high growth. That is, there's a growth in revenue, there's a growth in earnings, and there's a growth in DPS, that is the dividend distributed to shareholders also. Now, in addition to that, there are other factors also that the strategy is trying to look at. That is, the stocks have generated positive returns in last 1 year. The PE ratio of the stock is low. So this is basically the type of very good investment opportunities that we discuss, that there is growth as well as there is discount or some sort of value available in the stocks that this small case tries to select. Now the second small case is the growth at a fair price. Now, as we discussed just now, and you can also infer from whatever examples we have covered till now, that everything has got a fair price. Now, in the same example, or the second case where we discussed that the owner of the house was willing to sell you the house at 11 lakh rupees and you were willing to buy into it because you were anticipating a price increase. In the same case, if the owner would have asked you to pay 20 lakh rupees, a lot of us might not have invested into it, because we know that there is growth, but we know that we are not ready to pay such a high amount for the growth, because we don't know 5 years down the line when the value is just 20 lakh whether it will keep on growing or not, right? So even the growth has got a fair price, and this is what this small case tries to do. It tries to select growth companies which are fairly priced right now, so that such a thing doesn't happen, that you pay a lot of money just to try to buy into the growth. The first factor that this small case considers is high 3 and 5 year EPS CAGR. That is, the earnings of the companies in last 3 years and 5 years on an average are increasing at a very rapid rate. And it tries to find out the fair price or a quality stocks by using factors like return on capital employed and the net margins that the company is making. At the same time, it also checks for PE ratio and sees whether the PE ratio of the stock is lower compared to the sector medians not. So these are the examples of growth investing strategies that are up on the platform. You can again check out the whole, check out the full collection on the Discover page. Now let's look at the income investing strategy. That is the third type of a strategy. The case that we discussed in the example where we're trying to buy the house was when you wanted to buy into a house which was present in a locality where there were a lot of multinational offices, and you were expecting that you would be able to find high net worth individuals would be which would be like who would be willing to pay you high rentals in order to get a house which is very near to their office. So the use case for somebody to go and invest into dividend stocks or income stocks is basically that they want a constant stream of income, uh, like hitting their bank account on a regular basis, and at the same time anticipate decent amount of capital returns in future. Now, in order to understand this strategy better, we need to understand the different types of returns that a particular stock offers. So there are two types of returns that you can get when you're investing into a stock. One is price return and one is dividend return. Now let's understand it with a very simple example. Suppose you are investing into a stock and the current price of the stock is rupees 100. 1 year down the line, you find out that the price of the stock has increased from 100 rupees to 120 rupees. So you clearly are making 20% return on your investment. Now, this is what is called price return. That is the returns that you have made because of the price increase in the stock. Now, suppose in the same year, the company also announced a dividend of 5 rupees. Now, so at the end of the year, the total amount of money that you made by investing 100 rupees into the stock is actually 125 and not just 120. But the current stock price, that is 1 year down the line, the stock price would be 120. But 5 rupees you would have received in your bank account as the dividend by the company. Now, this is called the dividend return. So the price return in this example is 20%, the dividend return is 5%, and the total return that you made on the investment of 100 rupees is 25%. Now, when somebody is considering to invest into income strategies, they are basically trying to maximize the dividend return that they will receive from their investment, at the same time hoping for decent price returns in long term. Now, the graph that you're seeing is the 2 year performance of an equal weighted portfolio of income investing strategies that are available on the platform. By now, you would have noticed that the portfolio has generated a return of close to 45% in last 2 years. Now, this is way lower compared to the value investing strategies and growth investing strategies that we discussed. But the point to be noted here is that these are the price returns. All the charts that we have presented in the webinar are basically price returns, and we have not included dividend returns. So in these 2 years, anybody who would have invested into these income strategies would have received extra returns in terms of dividend that they would have got in their bank account. Now, at the same time, because you are receiving this dividends, it sort of provides a cushion also to the market falls that come in, and basically your total returns won't be very depressed because the price returns are getting depressed when the market falls. Now let's look at the example of income investing strategies that are available on the platform. The first one is the dividend aristocrat. uh, this is a very wonderful small case which selects top 10 like the companies which have been increasing their dividend payouts constantly for last 10 years. That is, for every single year consecutively for last 10 years, they have increased the amount of dividend that they are paying to their shareholders. Now, when one decides to invest into such a small case, he can be like surely say that the dividend income that he would receive from his investment will keep on increasing in future also, because the companies have a tendency to keep on increasing their dividend payouts. The second small case that we have included here is the dividend star. Now, this small case is basically built by using two different criteria. The first criteria is that the 10-year average dividend yield maintained by all the stocks in the small case is greater than 3%. And simultaneously, all the companies included in the small case have not cut their dividends for last 10 years. It might have happened that there were few years when they didn't increase the dividend payout, but there was not a single year when they have actually announced a dividend cut in their dividend payouts. So when you are investing into this small case, you can uh, you can think that the companies will at least keep on paying you the current dividend payouts that they are doing it. They might increase it in the future, but they don't have a tendency to cut down on their dividends. At the same time, there's a little bit of value angle also attached with this small case, because we are using dividend yield to select stocks. Now, dividend yield is the dividend return that you are getting on your investment. So the formula for calculating dividend yield is dividend divided by the price. That is how much dividend you are getting when you are investing the current price of the stock. while buying one share of their stock. Now, when you are investing in the companies which are constantly giving you a higher dividend of 3%, you can sort of be sure that at least 3% return will keep on coming in terms of dividends for like years to come by. So these are the examples of some of the income strategies that are available on our platform. You can again like check out the full collection on the collections tab on the discover page. Now let's just quickly recap the performance of all these different investment styles through a very comparative analysis chart that we have put out here. The first red bar that you see here in the 1 month section is basically the return generated by the Nifty in last 1 month. Similarly, the second red bar that you see in the 3 month section is the return generated by Nifty in last 3 months. The green bar that you're seeing in the 3 month section is the return generated by the value investing strategies. That is an equal weighted portfolio of value investing strategies in last 3 months. As you can see that the returns generated by them is more than 25% and very close to 30%. Now, as we can see that in each of these time periods, that is 1 month, 3 months, 6 months, 1 year, 2 year from today, value, growth, and dividend, all three investing strategies have like easily outperformed the broader market, that is the Nifty. You can also say that value investing strategy is best compared to the growth and dividend, but we need to uh, always keep in mind that the historical returns never guarantee future returns. So it might happen that in certain scenarios value investing strategies are working, but there are investors out who firmly believe into the growth investing strategies, that the strategy has a very high potential of giving you supernormal returns in long term. So whether you like value, growth, or you want a constant stream of income, the most important takeaway from the webinar is that there should always be a strategy. There should always be uh, a thought, an idea behind your investments. One should not go out and blindly put into the broader markets or mutual funds. You should always try to set an investment style or an investment approach that you want to follow or you closely relate with, and then do on your investments. That's when you will start realizing superior returns. So that's it from our side. See you guys in the next webinar. Thank you so much.